And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the Wednesday edition, the Hump Day edition of The Real Investment Show. And breaking news out this morning, of course, yesterday, the Trump administration announced that the 104% tariffs on China would take effect at midnight last night, which they did. This morning, China has now announced retaliatory tariffs of 84% on all U.S. goods. So tit-for-tat again. Now, this is not surprising. Again, as we talked about a couple of days ago, China, President Xi, it's a matter of honor. President Xi can't be seen as weak coming into this negotiation, so he has to retaliate. And every time that Trump retaliates, he's going to have to retaliate until they get to an agreement to come to the table to sit down and talk on equal footing. It's just a matter of honor, saving face. And I'm not sure if that's a message that the current administration is understanding or what's happening there, but again, this tit for tat with tariffs isn't surprising, but it is going to weigh on markets this morning. Futures were about flat this morning when I came in to start prepping for the show. Right after that announcement, the futures dropped fairly sharply. We're down 72 points right now on the S&P. NASDAQ's down about 187 points. So again, that's going to it's going to weigh on markets this morning. Again, just this back and forth between China and the U.S. on this trade deal is certainly just creating more turmoil in the markets, at least short term. And this is despite the fact that other countries are coming to the table to negotiate, but that's going to be a very slow process. We're trying to set up meetings now and have people fly over to meet with the administration, and if there's 80 countries to go through and you're doing 2 a week, I mean, you can kind of do the math how long that's going to take to negotiate trade deals, because these are apparently all custom deals that we're going to do with each one of these countries. So this is going to be a problem that's with us for quite some time. Markets aren't going to just keep going down forever, but there's a lot of downside pressure right now in markets just trying to recalibrate what tariffs mean. It's just a guess at this moment. Now, the good news is that hopefully we'll stop here, right? So the 104% tariffs on China, the 84% retaliation, hopefully we'll stop here at this level. Because as we said before, what the markets are trying to deal with is uncertainty, right? What's this going to mean to prices, trade, valuations, those type of things. And the more that it just keeps going on and on, it just keeps that uncertainty high. Once we can get to a point of stability where, okay, we're done putting tariffs on people, the markets can start to price out what that's going to look like, and we may find some stability in the markets here near term. Now, again, there's also another issue going on, and we're going to talk about this more this morning, but we are starting to see cracks in the treasury market due to what's called a basis trade. And this is something that has to do a lot with hedge fund leverage. We saw this back in 2019. We saw it in 2020. In both cases, the Federal Reserve stepped in to bail out the hedge funds. This was what happened in 2019. We were talking about reverse repo, but this was part of the basis trade. Back in 2019, the Fed had to step in, start taking the other side of that trade. We'll talk about what that is this morning in a little bit more detail. But that problem is showing its face over the last 2 days. We had very sharp jumps in bond yields over the last 2 days. Everybody's like, what's going on here? It's the basis trade. This will resolve itself at some point. Most likely the Fed is going to have to step in here to either cut rates or take the other side of the trade in terms of basically doing a form of QE to basically bail out hedge funds on this trade. That will help bring yields back down. But this whole big surge in yields, it's not recession, it's not inflation. This is the basis trade, and there's a problem there. That kink in the plumbing is showing up in the bond market. And bond markets are going to be off pretty sharply this morning as well, because that problem exists right now. That is going on. So we're going to get to more of that detail this morning and really get through that. But let's go through the markets this morning. Of course, we're continuing to kind of wrestle with what's happening, but this is kind of where we are and what you need to know before the bell this morning is that yesterday, we came down, we had that very sharp rally yesterday morning on kind of, some hope showing up the markets. Markets were up about 4%, sold off all day long, finished back in a negative territory, just basically, gave up all those gains from yesterday. It was a very big reversal day in the markets overall. Now, so the good news is that we didn't take out the previous lows. So that was kind of good news yesterday, despite the whole reversal of the rally yesterday, which was disappointing. Markets are starting to try to form some support here around this 61.8% retracement level, which, goes back to some previous support levels that we had. Markets are deeply, deeply oversold on a momentum basis. We're hitting levels we haven't seen in years in the markets, and on a relative strength basis as well. It just really can't have less relative strength at this point. So, but again, it doesn't mean markets can't remain under pressure. Certainly going to do that this morning because, again, just more of this news flow that's going on, just this whole kind of turmoil in the markets is continuing. Investors don't know what to do, so basically it's just go to cash at this juncture, and that's what's happening. So you're getting a lot of kind of panic selling. We're seeing a lot of selling in ETFs. One thing we had talked about previously is the impact of passive index selling on the markets because it's an indiscriminate selling. When I sell an S&P 500 ETF, it just sells everything in the market. So we've seen a very big jump in the number of indexed ETFs getting sold off in the markets, which is exacerbating the sell-off in the market as well. But we've had this very, very sharp decline. Sitting on some temporary support. We need to see this market. Again, we're going to open down this morning, but hopefully what's going to happen is markets will start to try to find some footing a little bit later on in the morning as we start to try to digest, kind of what's going on here in the markets overall. But again, we want to pay attention to this. Again, these really deep, deep oversold conditions are certainly something worth watching fairly closely. But again, I did want to talk about just real quick, kind of show you what's happening in the bond market, because again, this is something that, we're going to talk about more this morning, but I've been getting a lot of emails on this for the last, kind of really the last day or so. This is TLT, just a function of kind of what's happening. But I'll tell you what, let's show you the 10-year treasury yield instead. Kind of get a better representation of what's going on. This is that jump in the yields. We've had a very, very sharp rise in yields just over the last couple of days. And again, that's a function of that basis trade that's happening in the markets right now. And again, we'll talk some more about that this morning, but yields were dropping, got down below 4% on kind of the initiation of tariffs. It was going to lead to a recession. Bonds were doing exactly what they were supposed to do. Then on Monday, we saw this very sharp jump in yields. And again, that looks like we're getting liquidation events occurring in hedge funds, levered funds of various types that are participating in that basis trade, but also getting margin calls coming in as well. So as people have to liquidate margin, they're having to sell their good assets to go trade off and liquidate their other assets to fuel margin. So kind of got a combination of events. But this jump in yields is a function of the markets. This really doesn't have anything to do with inflation or tariffs or anything else. This is a function of market instability. And we want to watch this very, very carefully here, because if this gets out of control, it has a much bigger impact on the overall markets. But again, this is also where I suspect we're going to start hearing some rumblings from the Fed sooner than later, most likely. Again, we've got a meeting coming up in May. I don't know if we'll make it to May before we hear something from the Fed about this. But if this basis trade doesn't settle down in the next day or so and start to heal itself, I suspect we're going to have to see some form of intervention to try to keep the financial markets a bit more stable here. Again, I don't know, but we'll get into more of this morning. We'll talk about what the basis trade is, how it works, who's involved in it, and try to get some explanation around it. Also, Danny Radcliffe joining me this morning as well. So a lot of stuff going on. That's what you need to know before the bell. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So we told you often that, markets are markets. That's one thing. But if you really want to focus on the big risk to worry about, it always comes out of the credit market somewhere. And so far, credit markets have been fairly tame. We haven't seen big jumps in credit spreads yet. They've risen a bit, no doubt. When you ever have this kind of market stress in the markets, you're going to see credit spreads pick up a bit. But they're not at worrisome levels yet in terms of the rise in yields, but they are rising. But the one issue that is coming up is, and again, we've seen very sharp drops in bond prices the last 2 days. We're going to see it again this morning. Yields are going to be up probably somewhere around 2% this morning on the 30 years. So you're going to see a very big jump in yield statement. This is a function of what's happening in the bond market, and this is the function of what this is called the basis trade. So let's talk a little bit about what the basis trade is, if you're not familiar with it, and most people aren't. It's kind of one of those obscure things that happens in the background of the bond market. But it's basically an arbitrage strategy, and it's very popular for hedge funds, companies like Citadel, Millennium, Point 21. In fact, these are hedge funds that have massive regulatory assets, and they've grown over the last 3-4 years. These assets have absolutely exploded in these hedge funds, particularly companies like Citadel, which basically takes the other side of the trade for everything coming out of Robinhood, as an example. So, but you see this massive surge in these regulatory assets. So, you think about what blew the markets up in 1998. It was long-term capital management. And back then they had about $100 billion in assets. Now we're talking about multiple companies with hundreds of billions of dollars in assets that are sitting out there. Well, one of the very popular arbitrage strategies, way to make money, is called this basis trade. And this happens particularly in the U.S. Treasury market. And basically it's just the exploitation of the difference between the Treasury's price in the cash market and their futures contract. So again, futures kind of trade on their own relative to kind of what expectations are, kind of like commodity futures, oil, gas, gold, all those type of things. That's what the futures market is doing. But theoretically, right? So let's just take a real simple example to make this easy to understand. Let's say that you've got a gold bar, and in the futures market, it's trading at $3,000 an ounce, just to pick a number. But you may go down to a dealer, and the dealer says, yeah, I'll give you $2,900 for it, because he's got to make some money on it somewhere as well, right? So you're not going to necessarily get that the futures price in the market versus the cash price that it'll settle for right now. That's a simplistic example, but there's a $100 spread there between those two. So what if you could figure out a way to pick up and make a trade on a consistent basis and just keep picking up that $100 spread every time you do it? Well, that's what this is what happens in the treasury market. And so when you have a lot of assets, and maybe I don't deploy all of my cash at one time and, private equity investments or whatever it is, so I've got cash sitting over here. Well, I can deploy that cash in the treasury market, safe asset, right? We talked about the yen carry trade before, where you short the JGBs and buy the U.S. Treasuries, capture the spread between the yields. That's what this basis trade is, and it's a huge trade that is going on every single day in the market. So, and so this is what's happening. This basis trade is basically coming under a massive amount of pressure right now because of changes in yields and what's happening. And so you're getting this increased selling pressure in the futures, so when hedge funds execute these basis trades, they short large volumes of these futures. So as this yield move goes, the more they have to short. Well, if they get caught on the wrong side of the trade, this becomes problematic very quickly, and there's a lot of liquidity tied to this. And so this is, and so when we start talking about, kind of the issues of risk in the markets, this is something that, we had talked about before. So TBAC, which is the Treasury Borrowing Advisory Committee, they just wrote in January of this year that anecdotally 20 times leverage appears to be a good approximation of what's happening with those trades. So think about that for a moment, right? I take $1 million and I'm leveraging it 20 times in the market. So if something goes wrong, you can have a very rapid unwind of this situation. So on Friday, bonds, the bond yield was below 4% on the 10-year Treasury, which is where it should have been going given tariffs and the potential for a recessionary impact in the economy, et cetera. That 10-year Treasury yield below 4% was going in the right direction. It was hedging off that risk for an economic downturn. Now, Monday and Tuesday, yields have absolutely exploded higher, well outside the move in Treasury yields. That's a function, and what we said on Monday is that looks like somebody's getting margin calls, right? There's a hedge fund in trouble. There's something going on here, but somebody's being forced to liquidate treasuries to cover an asset trade of some sort. 2 days later, we find out that there's a problem with this basis trade now going on, and there's this unwind that is now happening with these leveraged trades. So this unwind risk is the threat that we've talked about for some time. That's the big concern for the markets. It's not just tariffs aren't the issue. Tariffs are one and done. Once we know what these are, the markets can price them in and we can move forward. That's okay. We still have uncertainty around tariffs, obviously, today with China retaliating with an 84% tariff hike this morning on top of the 104 from us on them last night. So this is just tit for tat. Again, that's certainly contributing to the uncertainty of the markets. But this sharp rise in yields has much more far-reaching impacts on liquidity of the markets, on stability of the markets. And again, when you talk about what's the lifeblood of the market, it's not stocks, it's bonds. Everything revolves around credit. So a very sharp rise in yields all of a sudden disrupts credit markets, it disrupts borrowing markets across the board. I mean, there's many impacts to this that have much more far-reaching impact on financial markets outside of just tariffs. And again, this is one of those events, as we've talked about repeatedly in the past, is that's the thing we want to watch the most. We want to watch the credit markets because it drives so much of what happens. Now, This is an early event right now that we're talking about. This isn't, oh my gosh, go panic and sell everything you own. I'm not saying that at all, but we need to be watching this very carefully. The last time that we had these types of issues in the credit markets were in 2019, 2020. Both times the Fed had to step in and start to bail out these hedge funds. And remember, we talked about in 2019, in September, we started having this big blowout in the repo yields. And overnight borrowing was running at 10% yields. And we're like, something's not right here. Something's not happening. And we had to see the Fed step in to start, solving the repo problem at that time. That was basically a function of the basis trade as well. 2020, we saw the same thing. Markets completely collapsed during the pandemic. Fed had to step in, start bailing out the markets. Well, here we are again. And we look at this and we go, well, why do we keep bailing out hedge funds? It's a good question. Don't have an answer for you. But the impact, again, and this isn't a new thing, right? We go back to 1998. That was the first hedge fund we bailed out, was in long-term capital management back in 98 and 97, 98. So this isn't unprecedented. The magnitude of these bailouts are getting dramatically larger because, again, once you start looking at the regulatory assets that these funds have and start talking about 10, 15, 20 times leverage on those assets that are being traded, you start to kind of get the magnitude of the potential risk to the bond market and ultimately to the economy, to the stock market, everything else. Because once the liquidations have to occur, and we've been seeing this for the last 2 days, so these big moves on Monday and Tuesday in the markets, this 1,000 points down day, 1,400 point down days, very similar, by the way, to what we saw in 2020, right? We shut down the economy in 2020, saw this massive shutdown, and markets were dropping 1,000, 2,000 points a day back then. We're seeing that same type of impact over the last couple of days in the markets, these very, very sharp downturns in the markets. That's a function of this unwind in the credit market that's happening, right? It's this forced liquidation that we're seeing across the board. And again, you can kind of almost tie it back to last Friday. We saw this on Friday, markets were under pressure. And you almost can see that on Friday night, after the market closed, people were getting phone calls saying, hey, you need to cover your line of credit on Monday morning, right? We're calling in your margin, whatever it is. And on Monday, that liquidation started. We saw it all day Monday, we saw it all day yesterday, even despite the fact we had these kind of brief attempts at rallies, they weren't able to hold into it. So we'll kind of keep you up on this. We'll talk more about it with Michael Leibowitz tomorrow on the show. But again, this is the thing we want to watch. But if there's going to be a move by the Fed, it's going to be because of this, not because of tariffs, not because of recession concerns. And this is the type of thing where they don't care about inflation anymore. This is about solving financial stability in the markets, which is their number one criteria. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your your payout. Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife is not a basketball fan. She never watches basketball. She doesn't understand basketball. She pays no attention to basketball at all. So she knows nothing about basketball.
The Real Investment Show podcast.
But her office had a March Madness pool on who would win March Madness. She goes, nah, I'm not doing that. Just do it. You might win some money out of it, right? And so she's like, fine. So she fills out a bracket. Well, they came to her yesterday. She's number one. She picked Duke.
At realinvestmentadvice.com.
This is the epitome of a blind squirrel finds a nut every now and then, because I don't even know if she knows who Duke is, my basketball phenom that I live with.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
On top of everything else we've got going on right now, we're entering earnings season. Walmart just announced earnings this morning. But the problem is with their earnings, you can't really look too much at what it was because we don't know what they're going to be so much. And they pulled their quarterly operating income forecast because they don't know what the tariffs are yet. So again, it's just all this flux. So how am I going to make forecasts when I don't know the countries that I'm importing goods from? Is it a 104% tariff or is it a 50% tariff? What's it going to be? So it's going to be very difficult for companies to offer guidance in terms of earnings and forecasts because of the uncertainty of where we are on tariffs until this is all settled. Now, once this is all settled, they can say, okay, now I know what it is and I can make forecasts. But one of the problems we're going to have this quarter with earnings is that we're going to see companies reporting earnings are going to beat estimates for the most parts, but there's going to be a lack of guidance most likely. We're going to see probably a lot of companies not be willing to give guidance because there's just no way to tell what the future is going to look like. And that's going to potentially be another negative for the markets near term because, again, what do we do as investors? We're trying to forecast. We're trying to buy stocks and forecast future valuations. I'm trying to assign a valuation today to what the future earnings growth is going to be. But if I don't have any guidance to work off of, it makes it very difficult. So again, on top of everything else, we're going to have this issue going on with earnings season. Now, there's good news to all of this. Stock buybacks will return on April the 25th. So we'll start getting companies back into the markets, buying shares back. We're in the blackout window right now. So we've also removed another big buyer from the market that's adding to the lack of liquidity. Right now, it takes $1.2 million worth of sales. So if I had $1.2 million in a bank account right now and say Apple stock or just an S&P index, and I sold it all right now, it would move the S&P by 1 point. So it takes so little right now to move the markets because of what's happening with the liquidity side of the market. It's exacerbating these moves in the markets. So again, this is kind of another problem. Of course, this weighs on sentiment. Then as it weighs on sentiment, more people sell the market, those type of things. It just kind of compounds on itself. And eventually this will exhaust itself at some point. Where? That's the big question. Is it near levels we're at now? Do we have to go a lot lower? Everybody's got their opinion. We just kind of navigate what it is right now. And unfortunately, that's just, the issue with where we are within this current market cycle. We've got to work through this, figure out where the bottom is, and then start to kind of rebuild from there and reposition and those type of things. So again, it's just going to, until we get some certainty, between Trump and China, and it really doesn't matter what's happening with all these other countries. There's, again, as I said earlier, there's 80 countries that have all come to the table and said, hey, we want to negotiate. Nobody cares about that. The only people we care about is China. So until there's some resolution in China, this market's not going to find a bottom, at least, probably not a lasting one at this point.
Well, but China was the main target of this anyways, right? I mean, that's where we're getting so many of our imports that we're bringing in. Mm-hmm. And so this would be ideal. And I think the sentiment has been, at least from the administrations, that, last time they did this in 2018 and 19, that they left a lot of loopholes. And so they were able to ship through other countries. And so they're effectively trying to, countermeasure a lot of those problems that they saw the first time. Mm-hmm. Now, being so broad-based and much different on deficit versus purely reciprocal, that's where I think the market's struggling. And then, like you said, forward guidance it's not worth the paper they're putting it on. And so, the one thing I do wonder, though, Lance, do you think the stock buyback programs actually ramp up because we've seen such a pull-off? Like, do you think companies are more inclined now, or with all the uncertainty, are they going to hold as much cash as possible, try to keep headcount there, waiting for this to change?
No, they'll start cutting employment.
Yeah. So you don't think they'll increase stock buybacks?
Yeah, they're going to increase stock buybacks.
Yeah.
Because corporate executives got to get their compensation. So they need price. Right now, there's a lot of option strikes that are well out of the money.
Yep.
So those are worthless until the stock price comes back up. So yeah, they're going to do stock buybacks.
Yeah.
Stock buybacks aren't about employment or anything else. It's about executive compensation.
No, correct. But you're going to have to reduce headcount if you don't know where things are going.
Well, that's a different story. That has nothing to do with buybacks.
Well, it does have to do with buybacks, right? Because you want the money you want to keep as much money in your pocket as possible. You're going to start shedding, headcount. So effectively, you have more money to do buybacks or to weather the storm.
Yeah. True.
So they're tied hand in hand.
Okay. Yeah, but no, what we're going to see.
Well, you sound real believable. Like, yeah. Okay.
Well, I mean, a lot of you take a look at a company that like Apple that has 150 billion in cash. They're not really worried about buying back shares,
well,
right?
Yeah.
So, but in small and mid cap companies, they don't do buybacks really of any consequence. It's really just the large caps, and so there's not really that big of an issue for those. Most of those companies have sufficient war chest to keep. If they wanted to keep employment where they were, they could. They're going to cut employment to boost profitability. So when they report earnings, which has nothing to do with it only has somewhat to do with buybacks. But if they need to meet earnings, beat earnings expectations, those type of things, and they can't do it through accounting manipulations, they're going to start reducing headcount.
Yeah,
and that's coming. That's I won't be surprised if you take a look at the number of bankruptcy filings that are going up. We're going to start to see, and again with these tariffs in place, it's going to slow the economy. It's going to slow demand. It's going to reduce inflation, but it's also going to increase unemployment. Because again, if I have slower demand, I don't need as many workers to meet the demand I have. It's all a function of supply and demand.
Yeah, that's right. And how much can you actually pass on to the consumer at the end of the day? And how much can you eat, which is profit margin, right?
Right. And again, there's only so much I can pass on to the consumer if the consumer has no money, which is the subject of this Friday's article, which is if you take a look at consumer stability at this point, there's a lot of indications that the consumers are really getting strapped at this point in terms of just trying to make ends meet. And we've seen, and again, you can kind of see that in the buy now, pay later programs. We're seeing, buy now, pay later was meant for large ticket purchase items. Now we're seeing people use it to go to McDonald's and buy food. And that's not really that great of an outlook for strong economic demand that I can push higher prices on.
You know, you and I've been looking at it, and everybody here, we've been looking at like credit card debt. We've been at all-time highs since 2023 back in October. And yet, you know, I'm sitting here, you and I are talking, I'm like, how do they keep doing this? And that's been one way that we've been able to kind of push this along further. And a lot of that doesn't show up on credit, like on the credit score.
Right.
And so you wonder how much of that is actually out there. And now we see bank decline rates have increased substantially. So where does it go from here in a sense of how much more runway does the consumer have, especially in this environment?
Yeah.
So this could get worse before it gets better.
On the economic front, absolutely.
Yeah.
I mean, the risk of recession is certainly rising. We take a look at the trailing economic data. It's still okay, right? GDP growth is fine. Employment growth, last report was fine, but it's all trailing data. This is all pre-tariffs, market decline. We're going to see sharp drops in sentiment, consumer sentiment, because of what's happening in the market that will feed through to consumer sentiment. Consumer sentiment is going to start to weigh on CEO sentiment, which we're going to see decline sharply, and we see that in the first quarter as well. CEOs have already announced that their sentiment is dropping, and we'll see that reflected in the data. But so again, a lot of the things that were very supportive of the markets, 3 months ago, those have changed dramatically. And now you're starting to see, just in talking about the consumer, article out this morning. This was on Bloomberg from Empower, which does they kind of have a financial website that you can go to, plug in all your financial information, et cetera, track all your investments, everything else. They discuss the alarming trend of early 401k withdrawals. These funds have become Americans' rainy day funds and used to prevent foreclosures and pay medical bills. An early withdrawal for those under 59.5, of course, comes with a 10% penalty. And what they're seeing right now is that they're seeing a very large increase in the number of people now withdrawing from 401k plans, and on an early basis. So they're doing it to meet funding emergencies at home, and that's certainly not indicative of a well-heeled consumer that can weather higher prices.
No, but that's been a problem for a while. I mean, we've seen 401ks, we call it leakage, where there's so many opportunities for you to take out of, and they've made it easier and easier. In fact, there's been marketing out there that says, look at all the things you can do with your 401k. And ideally, that's the problem we have. Many Americans are well underfunded for retirement, yet we give them the opportunity to pull from these funds and potentially avoid that 10% penalty and or pay it back, right? Everybody's like, oh, well, great, I'm going to take a loan out on myself. What we need to be encouraging is getting back to the basics and creating that war chest, that personal war chest for you, that emergency savings, the financial vulnerability cushion Richard and I have been talking about for about the last 5 years. So where you go a bit above and beyond, but it's not sexy. Nobody wants to do that, right? Everybody wants to say, hey, let's put as much money here, get as much growth as we can. And that is fine, but you have to build your house on a stable foundation. And if we're only putting everything into that 401k and something happens, which inevitably it always does, you're not providing yourself with the liquidity you need. You're basically taking from an asset that's designed for long-term use, not for day-to-day, which is where I think that we get so far in front of ourselves that everyone's encouraged, go start the 401k. It's the first thing you should do. No, you should start saving in your retirement account after you start saving and build up that emergency fund. Now, not saying you can't do them simultaneously and have something if you're getting the match, at least go get that. We don't want to leave free money on the table, but that's the problem, Lance. Most Americans have the majority that do have a 401k. Mm-hmm. A lot of their savings is in that retirement account.
Yep. And again, when you get into financial trouble,
yeah,
that's the only place you got to go. All right, when we come back, we'll talk about the best tariff trade right now, right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Well, the open this morning. And welcome back to the show this morning. Of course, getting ready to wrap things up. So Danny Radliff, of course, here as well, talking about just talking a little bit about this basis trade this morning. Certainly an impact in there's eruption in the bond market, right? And that's, we're going to see yields up again, probably close 4.5% this morning on the 10-year Treasury. So again, that's just what's happening here. There's just being this forced liquidation of assets at this point on the bond side as well as on the stock side. And again, it's just kind of running through the whole market. Started with the equities. It's been moving through to the bond side now. Eventually, this will resolve itself because you only sell so many assets. So at some point, you run out of assets to sell. But, that's just kind of where we are because of all this uncertainty. And I know this is very challenging here. But this is really kind of important right now to just not overreact. Sometimes you're just going to have to ride, it's sometimes like when you're in rough seas, you just kind of got to ride it out a bit until you get a better opportunity to start, readdressing issues. Now, you can certainly take, action anytime you want. That's fine. But the one thing, as we've talked about all week, is just to be cautious about overreacting, and going too far on things. Because, again, this market could change on a dime tomorrow if, and again, we kind of saw this yesterday with just a little piece of good news, right? The market's up, on Monday, the market was up 5% in just minutes on, fake news, but it was good news. So if we see any type of change in the tariff outcome of this at all, right? Some type of rational approach to tariffs or something, we're going to see this market rebound very sharply, which will give you an opportunity. Now, we're not at the final lows, right? We're going to go lower at some point. Most likely, we're going to at least retest lows, if not go ultimately lower, even after a bounce. So, use bounces accordingly to rebalance, readdress, those type of things. If you're looking for some good news this morning, a couple of things that were going on is that there is a massive surge in people buying the 3X long triple Qs. So somebody out there is taking some very large bets on the market being close to at least a tradable bottom here near term. And that's not surprising. We're seeing that. We're also kind of seeing the volatility index, even though we've had all of this kind of move in the market, we never got, VIX is high, we got up into the 50s, right? But we didn't even get as high. With all of this that's been happening, the volatility index never even got to levels that we saw during the Japanese yen carry trade blow up last year. So volatility, while it has spiked, again, you're looking for some silver linings here, right? Even though volatility has spiked, it hasn't just completely shot off to the moon like there's just massive panic in the markets. So again, we're seeing a few signs of stability here. Again, and again, if you want to kind of take a look at some, again, looking for a bit of a silver lining here. Yes, markets are going to be down this morning, but with the throwback from China of 84% tariffs, the markets are down about 1.5% right now this morning on the S&P. We're not down 4% like we were on Monday morning. Right. So, again, maybe getting a little bit of calmer response to the markets. We'll see how today plays out. What would be really good today is if we could see this market recover, maybe in towards flat, maybe even slightly positive. That would be a very positive sign for the markets as well. So, again, I'm just trying to point out a few silver linings here just to not leave you just, completely downtrodden this morning because, again, it's more turmoil coming out of the gate. And again, we want to really focus on what's happening with this basis trade in the bond market. I think that's going to be the story here over the next couple of weeks. We'll be monitoring that closely and trying to figure out how to navigate that as well. And then again, this is something where if the Fed doesn't show up and the Fed doesn't intervene, this could spiral into something much larger and much more important than what we're seeing with tariffs. But again, we'll monitor and navigate this with you over the next few days.
But inevitably, you do believe they intervene because of the propping up the banks, all the things that are going to be tied to it. Correct?
I'm not believing in anything. I'm just saying that historically that this is where they show up because again, what's the Fed's primary job, right? They say their mandates are
to prop up the banks.
No, it's don't you don't want to. Well,
the point is unemployment, interest rates. I mean, yes.
No, that's their mandates. Price stability and full employment. But their real goal is financial stability. Correct. That's their job. So prop up the banks. But it's about creating financial stability because if the bond market gets out of control, that has a bigger ramification on economic stability than anything else.
Yeah.
And so financial stability is really their number one interest. So if this is a real issue, and maybe I'm wrong, maybe this has nothing to do with the basis trade. Maybe I'm completely wrong. There's just some evidence of that. If it is, they're going to have to step in and help because they've got to come in and act as a buyer for those treasuries in order to keep yields under control. And again, remember what this whole purpose of the tariff thing was to push the economy lower, to get yields down so you could refinance the $9 trillion in debt this year at a lower rate, save $500 billion in spending. You're not going to be able to do that 4.5%,
which is initially what happened, and now we're seeing.
Now you're at 4.5%. That's not working in the administration's favor for refinancing debt this year, or the Treasury. Scott Bessent also saying he wants to get yields down so he can refinance this year. 4.5% is not going to do it. So there's going to be some pressure from the Treasury and from the administration on the Fed to intervene as well to get rates down.
Yeah, absolutely. So, well, you're talking about kind of the glass half full approach right now. And I do think there's some other things that we can be doing that will actually help, and things that historically, especially right now with, the unknown with taxes, we've been more inclined to probably push that off towards the end of the year to see what the tax code looks like moving forward. But this may be a great opportunity, especially if we get a little bit more downturn here, to start looking at Roth conversions, to look at tax loss harvesting, going ahead and reaping some of those losses, taking those off the table, and then purchasing it again later, finding another investment vehicle in the interim. But don't make those knee-jerk reactions where you just get all the way out or all the way in. I have heard a lot more. I've had a lot more conversations on people wanting to invest more into the market, use this as a dip and a buying opportunity. But there's some things that historically, we're talking about just going back and thinking about past larger recessions or drawdowns. Mm-hmm. We haven't had any capitulation. I mean, to some extent, a little bit, but we haven't had much yet.
I'm looking at you funny because what would you call Monday and Tuesday?
Well, I think, but if you think about it, has investor sentiment or mindset changed that much?
Yeah.
No way.
If you look at all our consumer sentiment readings and investor sentiment readings are at the lows we haven't seen since the financial crisis.
No, I get that. Right. But I'm just saying, in general, usually we can use a lot of people as kind of a barometer.
Right.
And you have a couple people you've worked with forever, and you know who I'm talking about if you're listening. It's you.
You're the problem.
But but it's great because I usually know if they say, hey, we've got to get out, like, okay, we're at the bottom.
Yeah.
Right. Or let's start buying more. And you're like, ooh, okay.
Yeah. So if they're not there yet, that means we're not at the bottom.
I don't know. Yeah.
Okay.
And that's what I'm asking. I mean, because I feel like sentiment has changed in that while all the news and headlines says one thing, but in visiting with a lot of people, I feel like it's a little bit different this time than normal. And obviously this is a time of concern, but there are things you can do. Looking at Roth conversions now, I think we're going to ramp that up and start looking and saying, okay, especially if we get a little bit more of a downturn, there's opportunity to take some areas and just move from a traditional IRA to a Roth. That's something you should consider right now, especially if we do believe we're going to get some upside to this, which inevitably we will. We'll make it through this. The question is this a bigger, deeper problem? We get into a recession, markets dip quite a bit more, or do we get some type of resolution and markets respond well and we get back to normal, which is not out of the question, especially if you get Congress involved. There's been lawsuits, other things to stop Trump from doing this and moving it to Congress. That could change things very, very quickly. And so those are that's the tough part.
Well, actually, Congress has actually got a bill that they're talking about bringing to the floor, which would require Trump to run all tariffs by them first. But even if they get, and they could, 12 Republicans have agreed to vote for it, which would get it passed.
Yeah.
But he'll just veto it. So it goes nowhere.
For sure.
Yeah.
So, the other thing I think that you should be considering right now is that if you're making distributions, you are in retirement. Where are you pulling from? So we talked earlier about, that emergency fund, financial vulnerability cushion. Do you have cash in your portfolio? Do you have other areas that are doing okay? So now's the time to start rethinking, get with your advisor, get a plan and say, do we need to make any major changes? So for the most part, we have a lot of cash on hand that we're able to do so right now. But a lot of places, or maybe you don't have much if you're in your 401k or you're in other areas or 100% invested. So I know a lot of you out there are really smart with how you allocate funds and thinking about distribution planning, but that may be something else to consider and think about how do you do that to mitigate selling something at lower prices unless you're just really trying to take some losses and it's in a taxable account. But there's a handful of moves people can do right now and use this to your advantage.
Yep. All right. Other things that just kind of be aware of here. Besant, by the way, just came out on television and said, don't worry about the bond market. It's fine. There's no systemic risk
Everything
going on.
has been fine with him.
Fine. They're just nuts. So just forget everything I said this morning because Scott Besant said there's no systemic risk in the bond market, even though yields are spiking this morning and the bond market's freaking out. There's nothing to worry about. Right?
It's so funny because him and President Trump have been even Lutnick has just been, this is so good. Yeah. And we're all waiting to see, right?
They're the violinist on the Titanic. Yeah. So,
like,
I mean.
When at some point does somebody say, all right. But we knew that this strategy was going to be the initial impact, right? The question is, and what my concern is that you want to switch the supply chain. Those aren't shovel-ready jobs. Those aren't quick things that happen quickly.
Yeah,
I don't know.
All right, wraps up the show for today. Thanks for joining. And of course, we'll be back tomorrow with Michael Leibowitz. We'll get into the nitty-gritty of the basis trade tomorrow, what's going on with the bond market, the potential for the Fed, all that with Michael Leibowitz tomorrow, our resident bond expert. So tune in tomorrow morning for that. Get by the website today. Our new daily market commentary is out. Again, everything you need at the website, realinvestmentadvice.com. Have a great day. We'll see you back here tomorrow.